the stock market's average annual return and drowning in 2 feet of water have in common? Actually, a lot more than you might think. You're probably familiar with the stocks for the long run gospel. For example, Professor Jeremy Siegel wrote the book on it and is a regular on cable TV. His work, and backed by others, suggests stocks are safe over long holding periods, with an average real return of about 7% annually. Real returns, that's the one that includes inflation. Why in 2004 it cost $2.90 to buy a Big Mac, and today it's about $5.69. This 7% average return has become a standard bogey of success, with investors largely coming to expect this from equity markets, and it's something of a default expectation in popular investment models such as the 60-40 stock bond mix. But here's where it gets interesting. While technically accurate to say that 7% is the average annual stock market return for a long-term investor, what's rarely, if ever, talked about is the level of uncertainty inherent in this number. And at the end of the day, what really matters to most investors is not the average return, but the actual realized dispersion of possible returns. Using percentiles, researchers got under the hood to look at the range of possible outcomes around that 7% annual return assumption. This requires a little math, but don't worry. If Ron Burgundy gets it, we can too.
They've done studies, 60% of the time, it works every time.
That doesn't make sense.
Using historical return and volatility data for a large sample of developed equity markets, researchers modeled what the range of possible equity investments could look like over long holding periods. For example, research suggests that for an investor with a 30-year timeline at the 75th percentile, which is close to that average return number we hear so often, at the 75th percentile over 30 years, profit on a $1 investment compounds to about $9, or the equivalent to a 7.6% annualized return. However, if you're unfortunate and your returns fall into the 25th percentile, which a quarter of observations will, or 1 in 4 possible investors, over a 30-year period at the 25th percentile, $1 compounds to only $1.82 for an annualized return of just over 2%. That's a big difference between the 75th percentile, or about average, and the 25th percentile. Let's look at that gap in a different way. Let's say you're investing $500,000 at 35 years old and watching it compound for 30 years when you retire at 65. Getting the 25th percentile return means retiring with $910,000. Whereas if you get the average 7%, or about the 75th percentile of outcomes, this compounds to nearly $3.8 million in retirement assets. The lifestyle that these two different outcomes can fund in retirement are vastly different. This is a hypothetical example based on historical data, but the risk and real-world consequences such as these are faced by investors on a daily basis. So while it's technically true to say that the average expected return is about 7% per year over a 30-year time horizon, what matters to most people isn't the theoretical average stock market return, but rather maximizing the likelihood of funding a desired level of wealth or lifestyle in retirement. So what's the bottom line? If you or your clients are relying on hitting that expected average return of the market without consideration for unfavorable outcomes, you could be setting yourself up for some serious financial problems. This is no different from the possibility that you can drown in a river that averages only 2 feet deep. How? Imagine a river which is 1 foot deep over 95% of its area, so most of the river, but contains a central channel that's 20 feet deep with a fast-moving current. On average, hey, nothing to worry about here. The river is only 2 feet deep on average, but you can still easily drown in the main channel. And it's thought exercises like this that we like to find outcome and other protective investment approaches. When letting it ride on the chance of hitting an average return isn't good enough, new approaches such as derivative-enabled strategies and structured products are now available that have the potential to help shape a better investment experience. Financial advisors want an investment with a built-in level of downside protection, or curious what structured notes are currently yielding? Hit that like and subscribe button and check out the links in the description below to get in touch with us.